How many of you realtors out there have an investor client right now who's stuck because the bank won't lend enough on, say, a townhouse project or a small multifamily build? Well, what if I told you that in about a year, those same banks might suddenly say yes and lend 10 to 20% more and at better rates? If either of those made you lean in, keep watching, because last week, Canada's banking regulator, OSFI, proposed rule changes that could completely rewrite how development deals get financed. I'm breaking it down in plain English so you can explain it to your developer clients tomorrow and look like the smartest agent in the room. On November 20th, 2025, OSFI, which stands for the Office of the Superintendent of Financial Institutions, which is an independent federal agency in Canada that regulates and supervises banks. They supervise insurance companies and private pension plans. So these are the people who tell banks how much of their own money that they have to keep in reserve. So OSFI opened a 90-day public consultation on new capital rules for 2027. They're specifically looking at loans for acquisition, development, and construction, and what that is called in the industry, ADC loans. So right now, currently, when a bank lends money to a developer to build houses or build townhomes or build small apartments, regulators make the banks treat these loans as super risky. In other words, they have to hold a lot of capital against them, sometimes up to 150% of the loan amount for low-rise projects. And that makes the loan expensive for the bank, so they either say no, or they charge higher rates, or of course they lend less money. OSFI is now proposing to lower those risk weights, and here's what they're suggesting. Low-rise residential drops from 150% to 130% of the loan amount. Projects with 75% or more pre-sales could go as low as 90%. And loans with a loan-to-value under 80% can be treated as finished and cash flowing the second the occupancy permit is issued. So what does this mean in plain English? Well, banks park less of their own money, making the loan more profitable. Again, which means that they can say yes more often and at better pricing. So why is this such a big deal? Let's make sure everyone's crystal clear here on why this matters. So imagine that you are a bank and you have $100 to lend. If regulators say that you have to hold $150 in capital for every $100 you lend on construction, well, you can only make a few of those loans. But if they drop it to, say, $90 to $130, suddenly you can make a lot more of those loans with the same capital. That extra capacity has to go somewhere, and it's going straight into residential development. Now, for a real-world example, let's say your investor client wants to buy a $2 million lot and put 6 townhomes on it. Today, the bank might only go to 65 to 70% loan-to-value because of the high-risk aspect. Under the proposed new rules, with 75% pre-sales, which good agents help create, it could push that to 80 to 85% loan-to-value and shave half a point off the interest rate. That's $200,000 to $300,000 that your client doesn't have to raise privately at, say, 12%. That's the difference between the deal working and the deal dying. At the Real Estate Investment Institute, one of the many aspects that we teach on is the 8 profit centers of real estate investing. This proposal directly implements 3 of them. Forced appreciation. More financing equals bigger or more ambitious projects, which equals higher end values when you sell or refinance down the road. Number 2, leverage. The bank is willing to lend more, which means your investor controls more asset with less of their own money in the deal. And number 3, mortgage paydown. Lower rates mean more of every payment knocks down the principal faster, systematically building net worth. Real estate investment specialists, trained agents already know how to structure deals to hit those 75% pre-sale thresholds and keep the loan-to-value under 80%. When these rules go live, you'll be the agent developers call first because you speak their language, investor language, and have the connections, those lending connections, to get their projects funded faster. But it's important to note, this is still a proposal. The consultation runs until February 18th, 2026, and the final rules are expected in September of 2026. And if it passes, implementation is proposed for November 2026 or January 2027. However, nothing is guaranteed. Feedback could change things. But The government has publicly backed this direction, so the odds are very high that it happens in some form. Macro risks are still there. Interest rates, construction costs, municipal delays, but the signal from OSFI is clear. They want more housing built, and they're willing to let banks take on a little more risk to make it happen. Here's your 12-month head start. Number one, start talking to developer clients about beefing up pre-sale strategies today, because those who hit 75% pre-sales first will get the best pricing when the rules change. Number two, brush up on loan-to-value structuring and risk weights so you can explain this to lenders and make yourself indispensable. And number three, position yourself as the go-to real estate investment specialist agent for development deals in your market. The agents who understand this stuff in 2026 will own the development niche in 2027. Bottom line, OSFI just handed developers and sophisticated investors a massive tailwind. The agents who get in front of it will make a fortune. If you want to be that agent, the Real Estate Investment Specialist designation will give you every tool you need, from cap rates to DSCR to the full 8 profit centers framework and much, much, much more. Check the link in the description. Comment below. Are you excited about the easier development financing or worried it's just going to pump prices higher? Like, subscribe, hit the bell. I'll see you in the next one.